What is an RMD, a required minimum distribution, and what are the rules? Hello friends, welcome back to another video update. Today we're going to discuss required minimum distributions. It's a hot topic for the end of year. I get a lot of questions and I'm going to try to answer the most frequently asked questions that you have for me about RMDs. So if you have a retirement account, an IRA, a 401k, understanding RMDs is essential for your financial planning. So what is an RMD? An RMD is simply the minimum that you must withdraw or take out of your retirement account by a certain age, by a certain date. The purpose is to ensure you begin to pay tax on that money, because when the contributions were made to the retirement account, they were made on a pre-tax basis. Roth IRAs, which are after tax, are not subject to RMDs during the account owner's lifetime. Okay, when do you need to start taking RMDs? Generally, you must begin taking RMDs by April 1st of the year after you turn 73. Now, that is changing to 75, but as of in 2033, but as of 2025, it's age 73. Now, I almost always tell clients to not wait until the year after, but to go ahead and start that first year when they turn 73. Otherwise, you'll be doing two distributions, two RMDs in the same year. Think about it. If your RMD was $50,000 and you wait until April of the following year, which you could, you would have maybe $100,000 of taxable income added to your other income. So let's spread that out. Does that make sense? After your first RMD, you must take subsequent RMDs by December 31st each calendar year. Now, how are RMD amounts calculated? The amount of your RMD is determined by the value December 31st the prior year, so we have to know exactly what's in the account, divided by a life expectancy factor. These factors are published by the IRS. They have tables that have to do with life expectancy, and it's no secret, the tables are out there. What are the penalties for not taking RMDs? Well, if you fail to take your full RMD by the deadline, the IRS may impose a penalty of 25%, of the amount that should have been withdrawn. That's crazy. It used to be 50% until this recent legislation. Sheesh, that is unbelievable. Anyway, other key rules to remember. Okay, RMDs are generally taxed as ordinary income, not capital gains. So ordinary income, that's your tax bracket. Secondly, you can take your RMD in one lump sum. Some people like that at the beginning of the year, or all throughout the year. You can do monthly withdrawals if you want, so long as you meet your minimum withdrawal requirement. Thirdly, RMDs cannot be rolled over into other retirement accounts. It has to be taken out. You could turn around and reinvest it into a brokerage account or something like that, but it has to be taken out and be taxed. Fourth, if you have multiple retirement accounts, each RMD is calculated separately. You can total your RMD amount and take it all from one account, but each one is going to be a separate calculation. One last note. You can always take more than the minimum. I get that question. You can always take more, but you have to take the minimum to avoid the penalty. And extra withdrawals in one year don't count towards your minimum the next year. Oh, and remember, I just did a video on QCDs, qualified charitable distributions, as a way to satisfy your RMD and avoid taxes. So look up that video if you're interested. All in all, RMDs are very important, but you have to follow the rules. You have to follow the rules. So reach out if you have questions, if I can help you with your required minimum distribution. Have a great night. We'll see you next time.